A customer walks into a financial institution with more than $10,000 in cash. The teller asks for identification. The system prompts for extra information. A report gets filed with FinCEN. That report is called a currency transaction report, or CTR. And the first thing to understand is this. A CTR is not an accusation. It does not mean the customer is laundering money. It does not mean the business is suspicious. It does not mean the institution thinks a crime happened. A CTR is a required report for certain currency transactions. It is part of the Bank Secrecy Act framework, and its purpose is to create a reliable record of large cash movement through the financial system. Large cash transactions can be completely legitimate. Businesses deposit weekend cash. Check cashers handle currency every day. Money services businesses move customer funds as part of ordinary operations. The point of the CTR is not to label all of that criminal. The point is to preserve a consistent paper trail so regulators and law enforcement can see patterns when patterns matter. A currency transaction report is a report filed by a financial institution when reportable currency activity crosses the federal reporting threshold. At a high level, the report captures who was involved, where the transaction happened, what kind of currency activity took place, and the amount of cash in or cash out. The word currency matters. In this context, currency means physical cash and coin. A check, wire, ACH, debit card purchase, or internal book transfer is not automatically a CTR event just because the dollar amount is large. The report is about currency transactions. FinCEN's public BSA guidance describes the requirement as reports of cash transactions exceeding $10,000, measured by daily aggregate amount. Its CTR FAQ explains the same practical concept. When cash debit or cash credit totals exceed $10,000 in one business day, a CTR is required. That is why the operational question is not just, was one cash transaction over $10,000? It is also, did known cash transactions by or on behalf of the same person add up to more than $10,000 in a single business day? The CTR comes from the Bank Secrecy Act, the common name for the Currency and Foreign Transactions Reporting Act of 1970 and related amendments. FinCEN's BSA overview explains the core idea clearly. The BSA authorizes Treasury to impose reporting and record-keeping requirements on financial institutions and other businesses to help detect and prevent money laundering. The original concern was simple. Large currency deposits of illicit profits could move through ordinary-looking accounts. If no consistent records existed, investigators had no reliable way to reconstruct where the cash came from, where it went, and whether the same people were repeating the same pattern across multiple institutions. The BSA did not turn cash into contraband. It created a reporting and record-keeping framework. FinCEN's own history page summarizes the early BSA requirements this way. Banks had to report cash transactions over $10,000 using the currency transaction report, properly identify persons conducting transactions, and maintain a paper trail by keeping appropriate records. That paper trail is the point. A CTR is one data point. Over time, across institutions, those data points can help show patterns that a single branch, teller, or business owner may not be able to see alone. The number most people remember is $10,000, but the threshold is not 10,000 exactly. The CTR requirement is triggered by currency activity involving more than $10,000. That distinction matters because a transaction of $10,000 exactly is not the same as a transaction over $10,000. But this is not a game of inches. The real compliance issue is whether reportable currency activity by or on behalf of the same person exceeds the threshold during the business day. FinCEN's CTRF AQ says institutions aggregate individual transactions they know are conducted by or on behalf of the same person during a single business day. Debits are added to debits. Credits are added to credits. In plain English, cash in and cash out are not netted against each other. A business day of cash deposits is measured as cash in. A business day of cash withdrawals is measured as cash out. If known transactions in either direction exceed the threshold, the institution has a CTR issue to address. FinCEN has also issued guidance on aggregation for businesses with common ownership. The core principle is still knowledge. If the financial institution knows multiple transactions are by or on behalf of the same person, and they result in cash in or cash out totaling more than $10,000 in one business day, the institution must file the report. A CTR is not a suspicious activity report. A CTR is not a secret allegation that the customer is laundering money. A CTR is not a federal ban on large cash transactions. FinCEN's customer-facing CTR pamphlet says large currency transactions are not illegal, and that financial institutions are required to obtain information from customers when those transactions occur. That is the cleanest explanation for customers and frontline staff. The report is required because of the transaction type and amount, not because the institution has already decided the transaction is criminal. There can be separate issues if someone tries to break up transactions for the purpose of evading the CTR requirement. FinCEN's pamphlet calls that structuring and warns that it can have civil and criminal consequences. But the safe compliance message is simple. Do not coach customers around reporting. Do not imply the report is optional. Do not treat the filing itself as proof of wrongdoing. Follow the institution's procedures, collect the information required by policy and law, and escalate unusual conduct through the proper internal process. For MSBs, check cashers, money transmitters, and other cash-heavy businesses, CTRs sit right at the intersection of operations and compliance. The frontline team sees the customer, the system sees the dollar amount, the compliance function sees the broader pattern and makes sure the institution's records are complete, timely, and consistent. That is why CTR training cannot just be a legal definition. Staff need to know what counts as currency, when to collect information, when multiple transactions may need to be considered together, how to avoid customer coaching, and who to contact when something does not fit the normal workflow. A weak CTR process creates 3 practical risks. First, missing reportable activity. Second, filing incomplete or inconsistent reports. Third, creating messy records that make it harder to explain what happened during a review, audit, or examination. The goal is not to make staff afraid of cash. The goal is to make the process repeatable. So here is the practical takeaway. A currency transaction report is a required report for certain large cash transactions. It comes from the Bank Secrecy Act framework that began in 1970. It exists because large currency movement leaves a record that can support law enforcement, regulators, and financial institutions when patterns need to be reconstructed. The threshold is more than $10,000 in currency. Now, multiple transactions by or on behalf of the same person during one business day can be aggregated. Cash in and cash out are analyzed separately. And most important, a CTR does not, by itself, mean anyone did anything wrong. I'm a CAMS, Certified Financial Crime Investigator with over 12 years in this field, and I built fourth pillar compliance to help MSBs and cash-heavy businesses test these exact controls before a bank, examiner, or regulator finds the gap first. If you want a practical starting point, I left a free AML red flags checklist in the description. Educational only, not legal or financial advice. Built entirely from public FinCEN materials and published regulatory guidance.